everyone, a very good evening. You're watching The Money Show on ET now on the channel's Rise with India segment. I'm Veena Kapasi, and as you know, The Money Show is your one-stop shop dedicated to all your money-related matters. Here's what we'll be discussing today. I'm sure many of you guys, when you all have checked the newspapers, have seen several banks cut the MCLR, right, from State Bank of India, and now if reports are to be believed, even NBFCs are cutting the MCLR. But what exactly does it mean? Does it mean that you're going to get a loan at a cheaper rate? Will it impact your current ongoing EMIs? That's what we'll try and understand. Next on the show, if we look at the year gone by, that's 2019, it certainly was tough times for the debt market. But interestingly, companies' NCD issues have been gobbled up by the retail investor with no issue failing as such. So is NCD, which by the way provides a better interest rate as well compared to a fixed deposit, a good inclusion in your portfolio? And finally, 2019 was also not a great year for the housing market. What exactly is in store for 2020? Anurag has a very interesting report on that. We will be bringing on board Prashant Thakur to talk about the real estate sector for the year and even the decade to come. But before we do all of that, here's a quick look at the headlines. Tata's moved the Supreme Court against the NCLAT order that reinstates Cyrus Mistry as the chairman of Tata Sons. Says the tribunal is setting a dangerous precedent by undermining the wisdom of the board. Meanwhile, the NCLAT will also hear the Registrar of Companies plea tomorrow. Almost a triple-digit up move on the Nifty today. The index makes its way towards the 12,300 mark, driven by hectic buying in metals and PSU banks. The Sensex surges 300 points. Revival hopes fire up the steel sector in trade. JP Morgan says stocks are poised to enter an upgrade cycle as more price hikes may be in the offing. JSW Steel is already sounding optimistic. Management says green shoots are visible in the December quarter. The government is looking to tighten the noose around GST evaders. Revenue Secretary Ajay Bhushan Pandey will hold the long deliberations on the 7th of January with state commissioners on streamlining GST, curbing tax evaders, and will also mull on different ways to augment GST-related revenue. Good news for the Modi government. December manufacturing PMI improves the most in 10 months. It's backed by a solid jump in new orders that rose at the fastest pace since July. Ashok Gehlot government comes under fire over the 100 infants that have died in one particular state-run hospital in Kota, Rajasthan. Sonia Gandhi seeks details even as Mayawati lashes out at Priyanka Gandhi for her silence on the tragedy. Okay, those are the big headlines we're tracking for you all evening on ET now. But back to the Money Show. The topic that we decided to talk about is MCLR. Like I mentioned, many of you may have seen the headlines that told you about State Bank of India cutting its MCLR rates, followed by Bank of India, UCO Bank, several other public sector banks. But it's not just public sector banks. Even private sector lender HDFC and many NBFCs as well are expected to follow suit. So in the midst of this then, what exactly is it that your loan will look like? Will your EMIs reduce? Should you refinance your loan? What should you go and talk to your bank when it comes to EMIs? And of course, with respect to this MCLR rate cut. I have with me Rachit Chawla, founder and CEO of Finway. Rachit, thanks so much for joining us on The Money Show. I think this is something that we were expecting, right? Because the RBI, the government, has been asking banks that, look, we are cutting interest rates, but the banks need to transmit it to the customers, that's to the corporates, as well as, of course, to individuals like you and me, and hence this MCLR rate cut. So if you could just explain to our viewers the basic, how exactly does MCLR work? How is it essentially associated with our home loans, our car loans, or personal loans?
Yeah, so thanks for having me on the show. So MCLR stands for marginal cost of funds based lending rate. So it basically means that the banks raise money from RBI at a certain rate and they lend money to consumers at a certain rate. Now the margin between that is something that the banks enjoy, and that is ideally their margin on which they show profitability. Now MCLR was supposed to go down because RBI has cut its repo rate over a period of time to multiple BSP points. Now this eventually RBI has been pushing the banks to lower it so that the end consumer can get the benefit out of it. Finally, a lot of banks have lowered their MCLR rate, which means that the EMIs is bound to get lower, the interest rate is bound to get lower, and customers will get benefited. But mind you, this is for the new customers who will be applying for the loans. Now it is towards the bank that whether they will revise MCLR across all the running loans which are old also, because they essentially will revise it every year. So let's hope that across the board the consumer is the one who gets the benefit out of it.
Well, yeah, that's really the hope. But you know, Rachit, there's also a product called the repo-linked loans, which was introduced by a lot of banks, I think back in October or November of 2019. That's just about 3-4 months ago. So how exactly does this MCLR differ from repo-linked loans?
So as I said, MCLR is basically the bank which they decide on per annum basis. So any bank will not change the MCLR every quarter, whereas the repo rate linked is decided by RBI and they change it every quarter. So if you are in a repo rate loan, you are bound to see fluctuations in the interest outflow quarter on quarter, whereas in MCLR link, you will only see it revised once in per annum. That also when the bank communicates it to the customer. Ultimately, repo rate is very transparent because as soon as RBI changes, the bank has to change, whereas MCLR is dependent on the bank.
Yeah, that seems like a very, I mean, you know, if one is to follow the news, it's clear that the RBI, the government all want growth, you know, and if you want growth, then you have to cut interest rates. So the RBI as well, in all probability, will be cutting interest rates because in their last meeting as well, they said that they want to be accommodative. So why not just directly opt for a repo-linked loan where we know that, you know, once in 2 months, the RBI will take some decision, you know, instead of opting for an MCLR at all?
Now it depends on the objective of the consumer. Certain consumers would like a fixed rate of interest so that there is no surprises there. So they are also risk averse when they go for a fixed rate of interest, so that even if repo increases tomorrow, because we have to see both the sides, it doesn't mean that the RBI will always keep on reducing it. There will be incidents where RBI will increase it also. But the consumer has to understand what is their sole objective. If the consumer is happy that okay, I do not want to have any tension or any dark side, then they can go for a fixed one. Or if the consumer thinks that the repo rate is already very high and it's bound to come down, then I would suggest in that circumstances repo rate loans are any day better. And believe you me, right now the repo rate is significantly low. So people taking new loans have to be very cautious, because from here the chances of going the interest rate going low is quite minimum. It might bounce back in case of inflation.
Okay, that's very interesting. Yes, I suppose if you you know, have a repo linked loan that you'd like to take, then you will have to keep track of the economy as well and the you know, the fundamentals of the macros as they stand, because the government, the RBI as well, take their interest rate decisions accordingly. Okay, so coming back to this, you know, this cut in MCLR. First, it was, you know, the leader, State Bank of India, that cut the MCLR, and I suppose a lot of these banks then started, you know, following the leader. So, Rachit, tell me this, that today, if I am a home loan owner, does it mean that I will see instantly my next EMI bill will be lower than my, you know, my previous EMI bills? Will it directly translate into that?
So generally the banks will issue a letter to all the loan account holders that we have changed the MCLR, hence you will get benefited in terms of EMIs. So you wouldn't see a change in EMI, but if the tenure of the loan is suppose 12 months and that MCLR, with the lower of MCLR, it has helped you to reduce the EMI by 1 month. So you will get a letter from the bank saying your loan has ideally reduced to 11 months instead of 12 months. So you don't get month on month benefit, but the tenure of the loan is where you will see the benefit.
Okay, understood. Also, another point I wanted to talk to you about is essentially refinancing. I would request my producer to pull up that list of banks and the current MCLRs. Now, obviously, there are certain banks that offer a much more competitive rate, whereas some do not. So that brings me to the question of, for example, if let's say I'm in an XYZ bank that's currently charging me 9% in interest rate on my home loan, and then there's another bank that's offering me 8.2%. So why should I not refinance? So under what circumstances, Rachit, would you advise that customers should then move their loan account from one bank to another?
So I think the customers need to understand that changing their accounts and their loans to other banks very frequently adds as a negative towards their CIBIL. So in case they feel that they have been running a loan account for a very long period of time, they have been paying their EMIs on time, and their credit history is also good and very strong, and they might get a better rate from other institution. What I suggest them to do is they should go back to the actual bank where their loan is running, and they should talk to the banker that, see, I am getting a better rate of interest from outside, whether you reduce it or I will have to close it, because every single change of structure in loan will incur a cost. Now the consumer needs to understand what are the cost implications. If there is a consumer who's a good consumer for the bank's perspective, paying credit on time, I am certain that no bank will let them go to another financial institution. They will definitely reduce their rate of interest. Secondly, if the bank still doesn't reduce their rate of interest, then definitely there are other financial institutions where the consumer can go to, but keeping in amount the charges which will be levied by the earlier banks, so that they don't end up losing money from their pocket in the long run. They need to be very clearly calculate the risk attached to that.
Okay, and yeah, sometimes those costs itself associated, I suppose, with respect to switching that bank can completely eliminate any sort of interest differential as well that may be there, that you may have enjoyed when you're refinancing that loan. So I suppose that as well, do you think, Rachit, that too would be an important cost consideration, or do you think that's way too small to consider in the long term?
So I think whatever the tenure of the loan is, they should put it down in a pen and a paper, understanding the cost implications, because you don't want to be stuck in a situation where to say 1% rate of interest over a period of 3 years, you end up spending more than that from your pocket. So you need to be careful. If you feel there is a benefit, only then they should go for refinancing. And the first objective has to be saving of the cost. So the consumer need to understand whether they are actually saving it or is it just in the papers, because new loan accounts will also incur processing charges, other charges in the beginning. So it should be a win-win for customer. They need to understand that.
Okay, all right. So essentially, you'll have to do some sort of a bit of homework. You'll have to see, because at the end of the day, you have to ensure that net your costs reduce, in the long term, and only then consider refinancing. But I think with that chart that you can see on your screens, you can easily see the comparative. It's just about 5 to 10 bips between banks. So I really don't see what sort of a benefit as well one may be getting. Of course, unless it's a really big amount and it's really long term, but that's usually with the corporates for home loan owners, for car, auto loan owners, you know, it's too minor really to go through the whole effort of switching your bank. So I suppose you should be a bit careful before you consider refinancing. You know, folks, let me remind all our viewers as well that we're going to very quickly kickstart our Ask the Money Show segment. So if you have any questions or queries, you can call in on 24990300. That's the number appearing on the top of your screens with respect to any loan account that you may be having. It may be a home loan, a car loan, a personal loan, and Rachit Chawla will be here to answer those questions. Okay, let me take on board our very first query. It's coming in from Amit Patel. Now, Amit writes in to us saying that my home loan carries an interest rate of 9.4%. When I check MCLR, same bank offers me a home loan at 8.3%. Why should I not switch to MCLR? So I suppose he has a fixed interest home loan, if I'm not mistaken. And yeah, now he's considering switching to an MCLR. So would you advise Rachit then that he should move to an MCLR from being on a fixed rate basis?
So he shouldn't jump onto conclusion immediately. As I said, refinancing can be very tricky. For a marginal 1.1% benefit, he shouldn't immediately take a decision. First, he need to analyze how much tenure for his current loan is left. Now, once he takes into account, then he needs to understand the kind of money he will be saving after refinancing it through some other banks. Because there's going to be charges in terms of refinancing also. So that also needs to be taken in account. Now, once he goes ahead to refinance it, there might be chance that MCLR will increase in time to come, because as I said, we are sitting at a very low repo rate. We are sitting at a time where interest rates are almost 9 years low. So when I say 9 years low, he needs to be very careful vis-a-vis his tenure of the loan. So if his loan tenure is next 2-3 years which is left, I would recommend him do the cost analysis and then switch it. If the tenure is very long, then I would still suggest to refrain from it, because if he changes his loan or refinances it, there's going to be a lot of cost which will be incurred for just 1.10% of a difference.
Point. Don't jump to any conclusions. Carefully first analyze each and every pointer with respect to your current loan, the terms and conditions, and of course the MCLR one that you read about, and then accordingly take a decision. Okay, let's take on board. I have a follow-up question as well on that whole credit report thing. Rachit, when we look at MCLR and when we look at the final interest that comes in our hand, in our bill, or when the bank is finally offering us, I suppose that the credit rating as well has a lot to do with that additional spread that the bank charges over the MCLR or over the repo. So if you could explain to us that cost breakup. I mean, I'm sure usually what the MCLR is or what the repo is compared to what the customer will finally be charged will obviously be very different.
Yes, so it depends from banks to banks. As I said, MCLR stands for marginal cost of funds based lending rate. So every bank and every institution has a different MCLR. Now, ideally what it means is that per annum, the bank will come out with one certain X amount of MCLR. Now, if the customer has an amazing credit rating and he's the favorite customer of all institutions paying all EMIs on time, there might be a chance that the bank offers them that, okay, this is the MCLR, because you're such a good customer, I would want to retain you. You just keep on paying me MCLR, nothing additional. But suppose if that customer has created some defaults in the past, the bank will definitely levy MCLR plus the risk factor into account. So there's gonna be a risk factor attached to that loan, which might range from 0.5% and it goes as high as 5% also in certain cases. So that's why I always recommend the customers to pay the EMIs on time so that they can get the best deal available from all the banks.
Yeah, we cannot stress enough on this importance of, I think, paying your EMIs in time, making sure that your credit report is clean, because it has massive implications. I mean, not something as simple as, of course, home loan, car loan, but even your credit card, right? You can get better offers in your credit card as well, if that's any temptation for all those who tend to indulge with some purchases on their credit cards. All right, let's take on board our next question. Saroj Kumar has written in to us saying that are repo-linked rates applicable to education loan? He has a loan from HDFC Credila for a period of 10 years. Rachit, how would you help Saroj out? And would you even recommend, for that matter, that an education loan be shifted to repo-link, or do you take an education loan on repo?
So yes, I think they should definitely go for education loan linked to repo rate, because generally repo rates are at all-time low at the moment, and also a lot of banks have started offering this product. So a year back, not many people were aware that there are education loans also available which are linked to the repo rate. Now, since these products have been launched, I think it's a great win for all the customers, and I definitely recommend to link education loans with their repo rate. And there are a lot of banks which have started giving such kinds of loan facility to begin with. State Bank of India is also very actively pushing this kind of product.
Okay. All right. So that's, of course, Rachit's recommendation on Saroj Kumar's, question. And I think this would be something that a lot of parents as well who are watching would be interested in knowing, because it's around the time when a lot of kids may be prepping to go abroad. August is when I suppose the terms start abroad. So, this may be information that they as well could use. And Rachit has, of course, given his recommendation on how you could go about taking an education loan. Okay, let's move on to question number 3 then. Shalini has written into us saying that my bank offered me a home equity loan. Is it different from a regular home loan, and should I opt for it? Rachit?
It's definitely different to a home loan. So when we say home equity loan, that means that you need to have certain equity in that home. So suppose I go and buy suppose I go ahead and buy a new house. I do not have any equity in that, then that home equity loan will not be applicable. When I go for a home equity loan, that means the home value is 1 crore, for instance, but the mortgage on that home is left only to an extent of 25 lakh rupees. Now there is equity to the owner left to the tune of 75 lakhs. Only in that case the customer can go and avail home equity loan. But again, I do not recommend home equity loan, because generally the rate of interest is way higher than the home loan. Home loan are the cheapest loan across sector. So if you can actually go and take home loan, nothing like it. But if you already have a single mortgage running on that home, then you don't have any option but to go for a home equity loan.
Okay, all right. So that's essentially the explanation coming in. So, Rachit, just to summarize our conversation as well, will this be the right time to switch your home loan interest rate from a base rate to an MCLR, from fixed to MCLR? Would you recommend then our viewers do that?
It totally depends on the consumer's perspective. There are certain consumers who do not want to study the economy, who do not want any fluctuations in their fixed EMIs going out of the pocket, because to be honest, there's going to be time when the interest rates are low, there's going to be time when interest rates are high. This will keep on fluctuating from time to time. So for new customers, they can definitely see what are the options available in their hand. But for existing customers, I think it all depends on the tenure of the loan. If the tenure is very short, then I do not recommend them switching it. If the tenure is very big, then they can go for refinancing or look at other options like MCLR linked or repo rate linked loans.
But you know what, Rachit, while it may sound great that the the State Bank of India has been cutting interest rates, and they're offering one of the lowest rates, and many other banks as well are doing that, right? Because the RBI has asked them to transmit the rates. But today, me as a customer, if I want to go to the market and to the bank and ask for a loan, how difficult will it really be? Because we've been talking about this credit crunch in the market of sorts. How difficult is it then for an individual to actually get a loan from the bank and get it approved by the bank at the attractive interest rates that they are now offering?
So again, it all comes back to the credit status of that customer. If that customer has been paying on time to the financial institutions, I think it's the best time to avail any loan, because the banks and the financial institutions are looking for A plus category customers. They are going after the customers who pay on time because of the liquidity crunch. Now see, there was X amount of money with the banks to lend. Now I would say there is definitely liquidity crunch in the system. So banks have also become very choosy. If you have defaulted in the past, getting a new loan facility at lower rate of interest is going to be difficult. But if you have been paying on time and you are a good customer to all the financial institutions, I think you can easily avail new loan facility at the lowest possible rate. And as I said earlier, this is the best time to take more loans because the rate of interest is all time low. The repo rate is 9 years low, which is huge. So I think it's a great benefit for those customers who have been paying all the EMIs on time. Now they can actually reap in the benefits.
Okay. All right. Well, folks, there you have it. I hope you've carefully considered all the advice given by Rachit Chawla on what you should do if you are a first-time, borrower, if you already have a loan and now you're tempted by these new MCLRs that banks are offering. Rachit, thank you so much then for joining in on this edition of The Money Show and very patiently answering all the questions and queries received.